Alrighty. So in today's video, we're going to be talking about the jade lizard. So I've already talked about this jade lizard in another video of mine, but I'm going to go a little bit more in depth in this video. And I'm also going to share with you, two different ways that you can trade the jade lizard. So first off, before I trade any option strategy, the very first thing that I really want to take a look at is whether there are any statistics and data to actually back up that this strategy is at least going to be profitable in the long term, right? The last thing I want to do is to trade a strategy just because, I heard someone or maybe some other YouTuber say that they have been trading this and they're doing very well. And then I just blindly trade it without doing any due diligence on my own. I don't like to do that, right? So for yourself as well, I do suggest that, if you want to trade any strategy, don't just take the person's word for it or even mine, but rather go and take a look at whether there are any statistics and data to actually support that the strategy at least has a chance to be profitable in the long term. So as you can see over here, this is a study that's done by the Tasty Trade team. What they've done is that they have studied the jade lizard strategy, and based on two different exits, they have these results, right? The first one is if you hold it to expiration, and the other one is to exit it once there's 21 days left to expiration. The win rate for the jade lizard, if you hold to expiration, is about 86%. And if you close it out at 21 days to expiration, it's slightly lower at 81%. The other things that we want to look at is also the annualized ROC. So as you can see over here, if you hold to expiration, the ROC is slightly lower compared to if you exit at 21 DTE. But the most important one for me is this one down here, which is the largest loss, because this actually controls your drawdown and also your P&L volatility. For me, when I trade any strategy, I don't like to see very wild swings in my P&L. This can affect a lot of people in terms of the psychology as well, because many times when you see a huge loss, especially when the market makes a big move against your position, you can get affected quite a bit. So if you want control in terms of the P&L volatility, exiting at 21 DT can really help with that. Now, that is not to say that you cannot trade this strategy where you hold all the way to expiration. You can as well, and I'm going to share with you, a way that you can do this, which makes things, pretty simple to manage as well. The next data I want to share with you is this one over here. So this is the P&L graph. As you can see over here, this is the conclusion by the Tasty Trade team that managing early approach is a clear winner due to its superior return and volatility control in most times. So as you can see over here, if they compare two of the P&Ls, the one at 21 DT does slightly better, right? It's not that much better, but for the most part, if you were to be trading somewhere from 2010 all the way to 2020, you'll be, pretty much ahead compared to, if you hold to expiration. Now, one thing to understand about this strategy is that it's mostly somewhat bullish, because the main driving option strategy behind the jade lizard is actually the short put. So I'm going to share with you the construction of the jade lizard later on if you're not very sure of how to construct the jade lizard. But the thing that I really want to point out to you when you take a look at this P&L graph is that you can suffer severe losses and draw down. As you can see over here, 2008, if you were to manage at 21 DT or expiration, it's going to be a pretty big drawdown, right? As you can see over here, the market went down and the equity curve also corresponds to this. And if the market goes up, generally also the strategy is profitable. And then at 2020, as you guys know, it's the pandemic. So there's going to be a big crash as well. And over here, 21 DT actually didn't do as well at expiration, because somehow at the point of 21 DT is the lowest point of where the market was. And when you exited at that point, somehow you just exited the trade when it was at the biggest loss. And after that, the market recovers. So if you held all the way to expiration, you actually held through the drawdown. But that doesn't mean that during the trade itself, you won't experience that big loss itself, right? It's a very big drawdown during the crash. But if you hold all the way to expiration, the market actually recovered in the end. So there are still going to be ups and downs even though this is a high win rate strategy. You can see it's about 80+%, which is actually pretty decent. So about less than 20% of time, you're going to have these losses, and the losses is always going to be, most of the time at least, is going to be bigger than the win. So this is something to really understand when you're trading this strategy. Okay, so let's get into the actual construct of this Jade Lizard. So if you're not really familiar with what the Jade Lizard is really just a combination of two option selling strategies. The very first main option strategy that is really the driving factor of this strategy is the short put. So for example, you have one short put down here, and you're going to receive some credit for this, right? So let me just put it as though maybe you're going to receive about $1.50. So this is just as an example. Now this is the first part. Now, because the Jade Lizard also wants to capture credit from the other side, what you put is the call credit spread. So the call credit spread down here, I'll just put a C, also is an option selling strategy where you actually expect the market to kind of stay below the call credit spread. So you can see that we have a combination of two different types of strategies. So the short put is a neutral to bullish strategy, and the call credit spread is a neutral to bearish strategy. So what this strategy is really aiming to do is to try and capture the profits in between. So the call credit spread also is going to receive some credit. So let's say, for example, you get maybe, all right, let's just say it's about 70 cents. So you get a total credit down here about $2.20. So when you take a look at this strategy down here, you got to ask yourself, where is the risk? And the risk really lies down here with this short put, which means to say, if the market actually goes all the way down, this is where your Jade Lizard is going to start to lose money. But if the market actually goes up, you actually won't lose money. You actually still be profitable. Why? Because this call spread down here, the loss from this call credit spread is going to be lesser than the overall credit that you're going to take. So let's say, for example, right now we have about $2.20 in terms of the total credit of this Jade Lizard. Now, if this call credit spread down here, let's say it's about $1 wide, which means to say if the market goes past this call credit spread, you're going to lose $1 at most, because this is the max that you can lose on this call credit spread. So if you lose $1, but the total credit that you've received is $2.20, that means that you have a spillover of about $1.20. So if the market goes past the call credit spread on the upside, you actually still make some money. Now, the next thing that you might be asking would be, Davis, why don't I just trade this short put by itself? Why do I want to include this call credit spread and then reduce, the amount that I actually make on the overall trade? Because if I had just put on the short put, let's say, for example, it's $1.50, like I mentioned, and I do not have this call credit spread, if the market goes up, I'm going to make quite a bit. And that is actually a very fair question. But the thing is that with this Jade Lizard, the whole idea here is that the market is not necessarily going to go straight up. There will be times where the market actually goes sideways, or it does not go high enough that it goes past the call credit spread. So that is why there is the delta part where you have to choose. So for example, let me just draw back the short put here and then the call credit spread. So this call credit spread down here, how do you know what are the chances of this actually going past this call credit spread at expiration? Well, it all comes down to the delta that you choose here. So let's say, for example, if you choose a 30 delta for this short put, then it's going to be roughly about only 30% chance that it's going to go above this call spread, which means to say 70% of time, it will be below this call spread. And this gives you a chance to capture the profit on both the call spread and the short put, right? As long as it stays somewhere in the middle. Okay, so the next thing I want to talk about is the two different ways that you can trade this Jade Lizard. And how you trade this Jade Lizard really depends on what you classify this short put as, because there are two ways that you can trade this short put as. The first way is you trade it as a cash secured put, which means to say that you actually have the cash in your account to be assigned the 100 shares on this short put. So let's say if the market actually comes down and you hold it all the way to expiration, you have the cash necessary to get long the underlying shares. So if let's say it's at 576, that means you have about $57,600 to long 100 shares if you get assigned on this short put. Now, the other way to trade this is that if you do not actually have the cash or you do not want to get assigned on this short put, then you're trading it as a naked put. So this is the two difference. If you have the cash to go long the underlying of the 100 shares, it's a cash account put. If you don't have or you do not want to long the underlying, then it's considered a naked put. So if you want to trade it as a naked put, this is where you need to have the margin, all right, in terms of the margin account. If you don't have a margin account, then most likely your broker is going to show you the cash secured put amount. So whether you trade them as a cash secured put or a naked put really comes down to you and what kind of account type that you have. So let me just show you what I mean over here. By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. So if I were to go over to SPY, as you can see over here, this is SPY, this is the option chain. By the way, some people have asked me, Davis, what platform you're using? As you can see over here, I'm using the Thinkorswim web platform by Charles Schwab. So the first thing I would do is to construct the short put side of the Jade Lizard. So for this, I'm just going to use the example of 5 at 6. And then I'm going to go over to the call spread side. So for the call spread side, the key thing to construct the Jade Lizard properly is that the total credit that you receive for the Jade Lizard must be bigger than the call credit spread width. So let's say, for example, right now, just based on the short put alone, the credit that I receive is $3.45, which means to say that the call credit spread side, I can do it about 3 points wide, maybe 3 and possibly even 4 points wide, because the call credit spread itself will already have some credit. So over here, let me just go to somewhere around, let's go with 619. Okay, so 619, let me see if I can stretch it to 3 points wide. So 3 points wide will be about 622. And as you can see over here, I get a total credit of $4.51. So straight away, without even looking at the P&L graph, I know that this Jade Lizard construct has no risk to the upside. How do I know that? Because the total credit is already bigger than the call credit spread width. So in the event, if the market really blows through my call credit spread, what is the most that I can lose on the call credit spread? Well, it's going to be 3 points, which is equals to $300. But I've already received $4.51, which is $451. So there's roughly a spillover of about $1.50. So if I was to go over to the P&L graph, you can see, as you can see over here, there is no risk to the upside. And if I was to hover over to this end down here, you can see the P&L down here at the bottom, you can see it's 151. So it's pretty much what I just said. So when you construct the Jade Lizard, like I mentioned, it really comes down to whether you have a margin account or not. Because some people have tried to construct the Jade Lizard, and when they see my platform, they see that, hey, the amount is so much smaller than what they're seeing on their end. So as you can see over here, if I was to click this review, you can see that my buying power effect is actually only about $7,000. This is because I'm on a margin account. If you're on a margin account, you should see similar number as well. But if you're on a cash account, then this is what you're going to see. You're going to see $97,000. So for the most part, most people generally do not have that big of account, or they do not want to, put on so much risk just for one trade. So if you're seeing this, then it just means that you actually have a cash account and you would only be able to trade the CSP version. That means the cash secure put version of the Jade Lizard. But if you're seeing this number down here, that means you have a margin account. So you might be asking, but Davis, if I don't have a margin account, what can I do? Well, there are 2 workarounds for this. The first workaround is that you just convert this to what I call the Jade Iron Condor, which means to say, on the put side, you just define it. And defining it, what it just means is that you turn it into a put credit spread. So let me just go over to the put side. As you can see over here, this is an undefined risk strategy. Because it's an undefined risk strategy, this is where margin really comes into play. But if you turn it into a defined risk strategy, so let's say, for example, I cap it to 10 points wide. So let me see if I can cap it to 10 points wide. So 5, 6 minus 10 should be 576. but we have a problem here, right? Because we do not have 576. So I'm just going to use 575. If you want to round it off, you can actually just bring this a little bit lower. Now you have 10 points wide. So if you have 10 points wide right now, you can see down here your credit is $1.98, which means to say we need to adjust our call credit spread, because our call credit spread now, we cannot go for 3 points wide. Probably we can go for 2 points wide. So if you go 2 points wide, let us take a look whether we are able to construct this properly. 1 point wide, my apologies. So if you go for 1 point wide, you can have no risk to the upside. So same thing as well, you go to P&L graph here. And if you will take a look right now at the buying power, you will see it's much lesser. It's at 873. So this is the very first workaround. Now, the other workaround is that you just go for a lower price underlying. For example, let me just go over to the chart again. Let me just remove all these drawings. You can go for a cheaper underlying. So let's say maybe, for example, if I go to BAC, which is Bank of America. By the way, guys, I am not suggesting that you trade the Jade Lizard or any strategy on BAC. I'm just using it as an example because the price point is actually very low, right? It's about $46. It's much, much cheaper compared to the SPY. So if you were to trade the Jade Lizard down here, then the Jade Lizard would be much more affordable, even though it's a cash secured put. So let's take a look at NVIDIA. And let's talk about the strategy of actually trading it as a cash secured put versus a naked put. So let's first start off with the cash secured put. So the cash secured put actually is pretty straightforward. So again, let me just draw this out. And over here, the main key difference when you're trading this as a cash secured put compared to a naked put is if the market comes down, right? If the market comes down, what you can actually do is just leave the whole thing to expiration. Because if you leave it to expiration, at expiration, what's going to happen is that this is going to be assigned and you're going to get 100 shares depending on where you put this short put. And if you're very bullish on NVIDIA and you think that, you know, this is just a pullback, it's going to go back up in the end, then you're going to gain on the shares as well. As for the call credit spread side, all you got to do is just leave it to expiration as the market comes down. Now, some people have asked me before, Davis, if the call credit spread side do not have much credit left, let's say, for example, you sold it at 70 cents for the call credit spread side, and as the market went down, this call credit spread maybe went all the way down to about 10 cents. Can you close out the call credit spread and just leave this short put in case, you know, the market shoots back up again and then let the short put expire? Then the answer is yes, right? So this is a little bit more advanced whereby you're actually laying out of the Jade Lizard. And you can actually do that because once the market goes down and there's only 10 cents left, there's not much left, you do not mind not making that last 10 cents, then you can close out this call credit spread and then you just leave this short put down here, this cash secured put. So there is a possibility whereby the market could recover and go above this cash secured put before expiration. And then you're going to have the full credit on this cash secured put as well. That means you do not get assigned. And then you're going to make, you know, the most, at least quite a big bulk of this total credit they receive for this Jade Lizard. So this is if the market actually goes down. Now, what if the market blows past the call credit spread first? What do? Can you actually hold it to expiration? So if the market actually goes above down here, then this is where you actually want to close out before expiration. Why? Because if you don't close out before expiration, this could be actually assigned first. Because remember, this is a short call, and on individual stocks, which is American style options, if the market goes past the short call, the buyer of this call option can actually choose to exercise it at any time before expiration. So if you get exercised, or rather you get assigned on this, then it's going to be a little bit messy because now you're going to have 100 shares, or rather short 100 shares for this part, and then you're still going to have this long call. Now I'm going to talk about what if you are managing it as a naked put. So let me just draw this again. And over here, this is our call spread side. So this one down here, let's put it as the naked put. All right, let me put NP so you know that this is going to be on margin. So the difference down here is on the short put side. So for the call spread side, if the market goes past this, it's going to be the same thing as well. I would suggest just to exit at around 21 DTE. But if the market starts to come down here, then this is where you don't want to hold it all the way to expiration if you do not want to get assigned and you're trading it as a naked put, which means to say you do not have the cash to actually get assigned 100 shares of this. So the thing that you want to do is to also simply just exit at 21 DTE. So to put it in short, make it very simple. If you're trading it as a naked put for the Jade Lizard, then at 21 DTEs, just close out the trade. Now, the next thing I want to touch on is the entry, because I've got quite a number of people that would ask me, Davis, how do you enter into the Jade Lizard trade? So if you were to take a look at the Tasty Trade studies down here, what they did is that they just randomly entered into the trade. They entered in the trade. Once it's either the expiration or 21 DTE, they close it out and then they put it on again. So there's no real timing for them for these studies. And as you can see, without the timing, it's still going to work out in the long run. But if you're the type whereby, you don't like to randomly enter into the trade and you want to enter it where you feel there's a higher chance of it working out, then this is one thing that can help. And that is to use the stochastic oscillator, or maybe you might want to use the RSI as well. Basically, what this indicator does is that it kind of tracks the condition of the underlying. So in this case, you can see there are two lines down here. So if it goes above the red line at the top, that means is that it's indicating that the market is kind of overbought, which also suggests that maybe the market could come down. And if it goes below the red line at the bottom, then it's suggesting that the market is kind of oversold, which also suggests that maybe the market might start to come back up. Now, one thing to understand is that this indicator is nothing magic, and it's not like every time it has an overbought or oversold reading, the market is going to turn. There are certain times where the market is just going to keep going up, even though if it's overbought, or keep going down if it's oversold. So this is something to keep in mind. But if you just use this and at least you want a better structured way of entering the market, you can use this. So when would you enter it? When it's overbought or oversold? So you need to understand the Jade Lizard, where is the risk of this strategy? So like I mentioned, the risk of this Jade Lizard strategy is the put side. Because if the market goes past the call spread side, it's still going to be in a profit. So there's no point to enter it when it's overbought. So if you want to play it a little bit safer, because predominantly the risk is on the downside, then you can choose to enter only once the market is kind of oversold. So as you can see over here, let's take a look at NVIDIA in this case. If I was to go back to the chart down here and see when it's oversold, you can see that both times over here, okay, let me just remove all these drawings to make it a little bit clearer. During this time when it's slightly oversold, it coincides with this point down here. Eventually the market did go back up a little bit. Same thing as well. Over here it's oversold, then the market went back up again. So in this case, this is where you might consider entering into a Jade Lizard. But if you had entered into a short put down here, you probably would have made much more because the market kind of shot up. But that doesn't mean that the market will always shoot up all the time. There will be times like this. For example, you can see over here, the market right now is oversold, or at least at this period. And the market has started to come up, but we don't know where is the market going to go. Is the market going to go sideways? Is it going to go up slightly before coming down, or is it just going to tread slightly down? So at least this way, when you have the Jade Lizard, and that is the short put over here, and let's say we have our call credit spread above down here, then at least you have a chance to capture the credit on both sides. And this is where the Jade Lizard really shines. All right, so this is the Jade Lizard strategy. I hope you found this video helpful. And if you have, please give a thumbs up and I'll see you in the next video.